All right, good evening, guys. Ken at Tortoise Capital. Thank you for your patience. And this is the nightly strategy podcast for July 15th, 2020. I'm reminded of Janis Joplin's interview with Dick Cavett. And she has, I just thought, one of the great lines of all time. Cavett was asking her some question about, planning for tomorrow and doing whatever. And she said she didn't really make any plans because it's all the same day, man. And that kind of always stuck with me. She was very here and now, very in the moment. Well, the true storytelling workshop I was doing with Dr. Boji and his international crew finished up this week, and I made a proposal to them about how to develop that in the world. And one of the things that came out of that discussion was an effort to apply some of the principles of true storytelling to the way we conduct our collaborations and our chat rooms and so forth. And I think there's more we could probably do. And so I sent some emails to a couple people I think might be interested, Van, Miller, and Eugene. And we may end up doing some true storytelling collaborations, with Zoom, or maybe go to webinar or something where we get a little bit more interactive. And that will build towards kind of what we do in the annual research weekend. I owe you guys an announcement on that sometime this week. I think what we're going to do is we'll do the virtual presentations in September. Between now and the end of August, I'll be soliciting some people who are prepared to give thorough research presentations on their systems and their rule sets, have those things peer reviewed, and then presented in a set of concise traders reports that show how each of them has applied the various principles that we use, and complete with their rule sets and their histograms. That's really their brown belt test. And then the black belt test is when they're, bringing in their own research where they've gone, beyond, my systems and to the next level. And we've gotten some really interesting ideas that came out of that. So I think we're going to do that. We'll have those briefings reviewed and then commented on, and then with my commentary and the peer reviewers' commentary, and record the discussion sessions, and put together a nice package of research and application. And I'm going to price that at $1,000 for the package. We'll probably have a dozen, maybe even as many as 20 presentations. The folks that are making a presentation will just get the package if they've been approved for presenting, as a payback for the effort that they're putting in. Well, part of that whole journey, that peer reviewing and documenting your narrative, is really strongly aligned with the principles of Dr. Boji's true storytelling. So I'm going to turn that into some kind of a project, and they've invited me to write a chapter in their next book on this, talking about how we're going to apply it. So that's because I was running out of things to do, so I thought I'd sign up for that project and see how it goes. Well, let's see what we have today. So yesterday was a recovery from the sell-off down to the Bollinger Band mean, and had a really powerful follow-through. Then there was some favorable news overnight about Apple's tax case with Ireland and the EU, combined with some news from the EU of them putting together $1 trillion package of economic support for their businesses, and that generated a really large gap up it was right near the high of the day, and at the 10-day high and within a cat's whisker of the 10-day high and the RL10 peak. So it really tested this price level here very strongly at 323 and a quarter. It went up a little bit, but then had a significant sell-off during the day back to yesterday's high. But then, and that was where the RL10 finished, and that held here at about 319, call 320, made the low of the day, and then powered through to a pretty good close here at 321.85. Just think, less than 20 days ago, we were down here at 299, and now we're pushing the boundaries up here at 323. Talk about climbing the wall of worry. I want you to notice just how strong that RL90 can't even be bothered with. It's done nothing but just rocket straight up. And even the RL10 has gone through the changes here, from a low at 303 up through the changes to so we get an RL10 price, fair value price of 319.64, and the slope of the RL10 is still strongly up. We're going to notice we're going to notice that the 10-day high, as we looked at yesterday, raised significantly to kind of put some pressure to succeed here in the price, because yesterday the 10-day low was here at 304. Now the 10-day low has moved up to here to 309. Well, yeah, basically 309. And then when this falls off, then the new high, the new 10-day low is going to be here at about 311. So that will be the 10-day low for a while, and that's going to create some pressure again as this 10-day range compresses to fish or cut bait. Notice the slope of the RL30, the health of the trend. The RL30 extension is still pointing northward and strong, and the RL30 hasn't quite gotten above its peak yet, which is at about 318, but it has reversed and is motoring its way north. And I would just notice that that it did hold support at the Bollinger Band mean. So that's the 30 RL and that's the 30 SMA. And the fact that the 30 RL was able to hold and is sloping up is a very favorable sign. We notice the dragon has rolled down, made a belly down here at right near Z1 at 306, and then has reversed and is now sloping up. And you'll notice that the slope of the dragon is also very favorable. And then, so that's the dragon, that's the RL30, and then this is the PSAR extension, and that's very favorable. So when we take a look at everything here in the 10-day range, we see, the 10-day high, and then it's only a 4% channel right now to the 10-day low, and that's going to get even tighter. So with the ATR somewhere around 1.8%, it's really a just about a 2 ATR channel here in the RL10. So that makes, we use 2 ATR as the default for swing position. So, if you were buying a breakout of a 10-day range here and you were using a 2 ATR, your stop would be down here out of all this noise. It would be, well below the Bollinger Band mean and down here where the PSAR is now at 309. So that's what a reasonable swing trade that you want to hold for weeks looks like. So you're out of that 10-day noise. The RL10 was a winter briefly touched, I'm sorry, it was the fall, dipped into the winter. This winter was right on the edge of the zero line, though, so this was pretty close to going fall into the summer, but it picked up summer here at about 317. It's been in the summer now for a while. So this is pretty optimistic. The range of the day, was this much. It did this kind of action. Harsh move down, and then rebounded about 80% of that way to close well at 321.85. And now really to the upside, all it's got to do is get through high of the day, 30-day high, Z2, and the long-term fair value, and it's off to the races. 330 would be the next. There's not any resistance overhead at this point, except for the crack-fueled optimism of the Robinhood traders. On the way down, support level is still going to be the RL10 peak and the RL10 price. That's going to act as support, along with the low of the day, the Z1. Upper skin of the dragon to me looks significant now at 317.25. And really that's also the belly of the RL10, where it went up, briefly touched down, and then zoomed back up. So this edge of the river feels significant to me. Skin of the dragon, spine of the dragon, lower skin of the dragon here at 314. Bollinger Band mean, that also feels significant to me at 312. So that's like a 3% move from where price closed down to the Bollinger Band mean is a 3%. Could it get there in one day? Well, here's how far it has moved in one day. 2 days ago, it moved that far. Yeah, so when this thing sells off, it sells off about one red arrow's worth. So if it opened where it closed, it would really take two of those to get down and test the 10-day low, and really 1.5 of those to come down and test the Bollinger Band mean. So the support feels pretty solid for the upside moves. Let's see what worked today. All right, so the market itself, SPY, was up 0.92. The Dow was right there at a fraction away at 0.87, although it had started the day off very strong, and then the S&P caught up to it. I'm looking for the Russell. Where is he at? Am I missing the Russell? Oh, there it is. Okay. So the S&P at 0.9, the Russell had a big day at 3.67. You may recall me mentioning that yesterday, that the Russell had not participated as much as the other sectors and the broader market, and they were late to the game getting back on board. So I was thinking today might be a catch-up day, and it turned out to be the case. So big, strong move at 3.67 for the Russell. What was better than the S&P today? Well, healthcare at 1.3, discretionary 1.4, materials 1.7, finance and energy both, one at 2 and one at 2.2. Mexico, and then the oil exploration at 3%. Our big speculative movers were Win at 9.25 or 9.33%, Simon Property Group 7.5%, Twitter, now it's pushing 36, up 3.75. 36 was a magic number for me back when we looked at this at 28. Devon Energy 3%, U.S. Steel 3%. Now I'll draw your attention to our triple leveraged growth tech guys. So here's TECL. That's the old school tech like Microsoft, Apple, Intel. That was up like 2%. The triple Qs up 0.5. So the old school large cap tech did a little better today. There's our metals and mining guys. Alcoa 0.63, Nucor 1.5, U.S. Steel 3%. What was worse than the S&P? Well, Brazil 0.8, Apple, Virgin Galactic 0.69. S&P Tech XLK was down here by the triple Q. So in this case, the broad large cap techs of XLK were up only 0.5. The triple inverse, or the triple NASDAQ 100 only 0.49. Wheat and precious metals was positive. Facebook and Cliff were just about flat. Walmart just about flat. Microsoft, Google, Amazon, and that would help explain why the Qs and XLK were underperforming today. We're down, let's see, Amazon down 2.5. And then the triple energy inverse ERY down 4%. So tech was the laggard again today. I would not be surprised to see tech start to resume when the market itself is in that broad, pushing the upper envelope here. It's hard to see how the large cap techs don't resume now that energy and finance have done some of their business. Now, I think there's a lot more room to run in both the energy and the finance. So we've got some potentials in there. Let me see if I can get that to load in the background while we're waiting. All right. Let's take a look at the continuation patterns today. I traded a few. I'm going to try a new, see if I can get this thing to work. So Bamboo is a nice little tablet application, so I'm going to give this a try. I'm going to come back to this. Okay, good. So just to pick up where I stopped. So I sent out a note this morning noticing this large gap that was forming right here, double plus good gap and the potential for runaway gains. And I said, be mindful of those gaps. And I said what I was going to look at was TNA, UDOW, and TQQs as a way to exploit any upward runaway moves. But after the gap, I really didn't see that. In fact, if anything, it was initially a sell-off. And so I ended up, that led me, the failure to follow through became this kind of sell-off. And so that led me to SDOW. And I was looking to see if it would come down and close the gap. And that was the intention. So the first one I played today was SDOW. Bottom line, I did not get the follow through that I had framed. So I noticed this, it had closed here and then had a large gap down. So I treat that as a harsh winter. And I'm going to set where it closed as my upper target. So maybe if this thing doesn't fail, then I can play for a resumption. I'm really looking for this kind of a move here. And so I might just pick halfway up as a checkpoint. Then, that might be position one and then second target up here. So I look at like an opening range 5 here. It doesn't fail any further. So I'm and then it starts giving me this move. So failure to fail further is information. And I'm taking 0.15 risk. Then my target up to here is 60 cents. So that gives me a 4-to-1 trade frame. And again, if I only am going to get 2, then that would be pretty good. And then I can see that over here. There was a moment when it got close. So I take this entry. I decided to use the low of the day as my execution risk, knowing that at some point when the PSAR does flip, it's going to show me this as the supported spring crossing. But the size of the gap was so large that it's going to take a long time for that PSAR to flip, because you can see it has a long way to go. It starts up here, and it has a long way to go before it can flip right here. So I'm really trading this one as like a hybrid frog off the bottom. And I pick up this, I keep this in place, and I'm really waiting to see the PSAR start to get above. Now, we're under a lot of circumstances, this is, if I was using the Wu Wei, then that's where I would make that move. But I noticed that this move, which is about 40 minutes, at about 40 minutes into the day, has already gotten to Z3. So in a favorable excursion to here, I don't want to leave my stop all the way down here, because as you can see, that's about two boxes. So I decide to accelerate my stop here. I think a better play for me would have been just come right up to the Bollinger Band main. Now that I look at this, I think that would have been better, and just play it that way. That's probably better. But I took this exit strategy, and was basically following the PSAR, and I ended up giving back about one box and capturing about +1 execution risk. The fact that this is SDOW couldn't close the gap. That means that UDOW should be going up, and that would be a sign that the broad market's should be doing better. So that was the first trade, and didn't really get the follow through that I had been hoping for. Okay, so let's move. All right, so this is the next trade. We got some time compression here a little bit. So this is at trade number 1. It captured basically +1. And so that becomes a stop and reverse for me now. I'm treating that as a reasonable summer move. And I get the PSAR flip. So there's my risk box. I'm short. This is an area where I'd considered adding a second position because you have like a collapsing dragon. When you have it rolls down and then just flat lines and then drops again, I treat that as like a really good collapsing dragon. That's better than something that goes like this, where I'm taking a collapsing dragon here, and then this would be a pocket. This is one right here where there wasn't even a pocket. So you basically just flatlined and then fell for the next leg down. So that's when I look at that, that's how I interpret it. So this was an area where I could have considered adding a second position. I was really just hoping to see everything just fall out right here at the low of the day. And then that's where I was going to add my second position. So I was stocking up, getting ready to go right here, but it didn't fall through. In fact, it reversed, and so I get my exit here. And the standard Wu-Wei exit on this, let's get my red going here. And then by this time, right about here, is where the PSAR is two dots below. You have 1, 2, 3, actually 4 dots below. This is about where in the Wu-Wei exit. So somewhere right in here, you pick that up and just start moving it down. And then this becomes a sniper exit right here. And that looks like, if this is one risk box, that's about +1. So +2, +1, +2. And we had +1 over here. So we're about net +3 right now. And then this one is a stop and reverse. So that looks like a big harsh winter. And the last time it was about at that price level, it ran up. So we just play the standard stop and reverse. I'm going to use the belly of the RL10. And I'm doing that even before the PSAR fully flipped. I've been really fascinated with that technique that we have been discussing the trailing stop, the stop entry at 2 or 1 bar back. So on that case, we're watching the PSAR coming down the stack, and then before it flips over here, each time we're just lowering and lowering in the stop, and then this one reversed and came back up through. I got my entry basically at the same place I took my sniper exit, and then the PSAR flipped. So the Wu Wei exit, it stays right here until we have 1, 2, 3, 4, somewhere around in here. I join, and then I'm really tracking the Bollinger Band mean. However, when I saw this move, this breakout from a Z3, I'd considered adding another position here because we were +1 in hand. So rather than just drift along that, I accelerated the stop to here. But now that was a reasonable place because now you have the VWAP here, and you got, I have the +1, so I'm really at this point +4. But this is a short position, because we're going along the inverse, and I was a little bit reluctant. What I really wanted to see it do was get above this RL10 peak and the hump of the dragon. So rather than putting a second position on here, so instead of putting that position on here, I'm really looking to do that here. That actually happened because this thing ended up doing something like this. And so I got the first position here. I didn't take that one, but I did get a second position right about here. And then we exited that in the usual way. Had have been right around up in here. So we got a nice move here against that much risk on 2 positions. So this nets out to about +7. Playing the short side of the Dow mostly on a day when it had gapped up. So this is the Russell. So this is TNA, which is 3 times the Russell 2000. And this is about 45 minutes into the day. And instead of failing here, you'll notice the winter. What the hell? Oh, it's doing that again. Still learning how to use this pen. It's giving me some grief. All right, well, I don't know why it's not drawing for me now. Let's try again. God damn it. Pardon my language. All right, well, that's supported spring crossing with 2 entries in the usual way and finishing up with the Wu Wei exit. I'm sorry, my drawing pens, it's just not working. So that one works out to about 1, 2, 3, 4, 5. That's about 6 in the morning. So it's turning out to be a pretty good day. Now I'm getting pissed. Machines should work. People should think. I'm not creating much value for you right now. Right, we're going to go right to the dailies. Sorry about that. All right, so we're looking at bullish normal conditions, dramatically overbought all across the board. We've got a nice 4% cushion to the sideways. Strength of trend is still very weak. ATR percentage came down 0.1%, so we're still in normal. That's where the normal in volatility comes from, is from that reading right there on the ATR percentage. Risk Z is still risk on, and at 0.54, we are still early in the unfolding of the swing trade, which just got a lot stronger today. So that's favorable. The moves of the last 10 days have been pushing the upper boundary of the overbought consistently. No signals in channeling an overreaction. Couple interesting candidates in here for the max pain: Microsoft, Goldman, and Intel. Then Amazon and Devon Energy. I mean, if you ever wanted to buy Amazon on sale when it's a max pain, that's probably a chance to start stocking that. Simon Property Group is also at an extreme condition, so that looks favorable. The Dow has been the strongest of the indexes now, so he's at a min pain, DIA. A handful of good dojis to look at. Now, all of these in the red stack here under the overreaction short, those were things that had been weak, but which have bounced so nicely that if we get weakness, then that becomes a candidate for potential short. So that's how you read that. That was one that were beaten down the most, but had the sharpest rebound, and therefore that becomes interesting. This little cluster in here of Microsoft, Verizon, and United Health. Only Walgreens tests out well. fucking piss me off. Only Walgreens has a 2.4 auto framer. Everything else is so close to the 10-day high that there's just no wiggle room in there to set up that kind of a swing trade pattern. No breakouts in the NDXs. In the ETFs, so ETF 30 up next. I got four dojis to look at there. Our old buddy XLB, the SPY itself, the market is in a doji, at compressed range. Oil exploration, and it was a percent winner today, so that's pretty cool. And then energy has had a nice rebound, and now it's postured to have to make a decision. So you look at energy here, and you say on the 1 day and the 10-day it's been positive, but on the 1 month it's been horribly beaten down. One of the worst sector out of all of them. So you've had a very harsh sell-off, and then a 1/3 retracement. So now we're going to find out if this little rebound in energy is tactically is over, or if it's genuinely making a rebound. So we're going to see. Walmart and silver are the two most positive Z stretches. I'll let that come up. So Walmart and silver have relative strength compared to our other standard candidates. All of the U.S. indices are in between the Bollinger Band mean and Z1. So nothing to see there. I find this pretty cool. Cliff is getting into a very tightly compressed pinch box, as is Walmart, Gold, and Intel. Intel and Microsoft close behind. So getting ready for a breakout move in those. You can see the framing data for Walgreens on that 2.4 to 1 reward to risk ratio. In the RLFF top shelf, these are the ones that are the deep value plays. Still, like in Mexico, for rebound potential. Then the bottom shelf, these are the ones that have the best relative strength. Now notice Microsoft has fallen out of that list now because he's on a 10-day max pain. So Microsoft is at a moment of advantage here. That's another one that could be of interest. So Amazon and Microsoft should be on our short list to look at. Damn it, come on. There we go. All right, so lots of symbols on the daily squeeze. So today was not the big runaway day that I was expecting or that was implied by the big gap. So when you have a relatively compressed daily range, then you have the possibility for these breakout moves. It acts like a coiled spring. So we're going to notice that the S&P and energy and diamonds are all around 2.1 to 1 in terms of there's a 2 to 1 reward to risk ratio. If it breaks out of the daily range, it could go and just goes a full average range move. It's going to be a nice pop. So looking for a big directional move from those guys. And up at the top of the stack, there's one for Van on 3M, and materials are interesting. And there's ExxonMobil and healthcare. Four Seasons of MACD, looking at the enormous number of symbols in the summer. In fact, only Boeing in the winter. These symbols that are in the spring are the ones that are really lagging. They haven't even crossed above the Red River yet. They're not even into the Red River, and they've just made their turn. So that's Mexico, real estate, and energy are really the lagging sectors, but they have made the turn from the winter. Only Boeing is in the winter. And then Microsoft and Cisco have sort of fallen from grace. Microsoft used to be down here, leading the pack, but now that's not so much. Here's your relative strength winners here: Walmart, Johnson & Johnson, Procter. Amazon and Apple still in great shape in the summer. XLV, the strongest sector in terms of relative position in the Four Seasons. Lots of good breakouts today in the NDX. Goldman is the one that has the most relative strength. You see that it's been overbought significantly 30 days and 90 days. So it's been an outperformer, and it continued to outperform today. So that's a good thing for Goldman. That strength we saw in the metals today, metals and mining, could be some follow through. And XLB is really starting to run amok. Look at this, big breakouts everywhere. And then energy and XOP. You notice that they had been underperforming in this intermediate time frames, but they've been on a nice run the last 3 days. So it could be just a reaction to oversold conditions, or it could be the start of something big. So we're going to we're going to see what that's all about. Just notice how tightly compressed this trading range has been the last 30 days, and that has brought the slope stat right back to the long-term average, right around the zero line, just barely above zero. And that's consistent with that long-term average. The stretch away from the 200-day moving average is actually a pretty good. That's a pretty good move starting right now. See, it's been clustered right around the long-term average for about the last 30 days, and the last 2-3 days it has just started to make its move. Volatility back to about normal. The 90-day move is still one for the ages. That's a 4 sigma 90-day recovery from that big sell-off we had down there. This 90-day move from here to about here is a 4 sigma move. That's how good that's been. The 30-day has come back to the zero line, and the 10-day rolled over slightly. But now that it's back inside the normal boundary between plus and -1, there's now room for an upside move to break out, because it's the 10 and the 30 have cooled off enough, and now there's a chance to go up here and test a strong move. So there's an increased probability of this upside move for the next 2 days. So that's everything I'm going to cover on the daily. There were a couple of the charts in the chat room that I wanted to really address. So this is Griff. Griff completed his kata number 1. And I'm presuming that since you're going short here, that you were doing the SSC and SFC. And that, so he's not using the Wu Wei. What he's using is the PSAR. So what I want you to notice is that if you're using the Wu Wei, you don't take that exit there, and you don't even take the exit until it comes all the way there. So you end up saving, a half an hour loss if you're using the Wu Wei exit. I'd argue with you that this shouldn't be an entry at all, because this is not a harsh winter. That's just a PSAR flip. That's a nothing. You're trading inside. Both of these are trading inside the river, so that's minus 1.3. That should be no trades. And if you're going to take those, though, why wouldn't we take this? So I don't think, I would say those are not kata, because you haven't, that's a sideways quiet channel for the ages. But I do want you to notice the Z3 breakout is available there. Now on this one, if you're using the Wu Wei exit, I want you to notice that you'd keep that as a solid stop. Draw this line. You keep this as a solid stop until the PSAR gets below your entry, which doesn't happen till over here. So your stop is actually here, and then it comes down and picks up the Bollinger Band mean. So this entire move actually would pay off if you're using the Wu Wei exit. You probably sniper that or get to here. So the Wu Wei exit not only is relaxing and mechanical, it also helps you during the chop when it's just trending sideways. I'm going to send you separate notes on you sent me some ideas on some reflections and updates. I'm going to give you a more structured after action review to follow. But that was a very good start. This one, so you're short here. And I don't know why. That's if this is the kata, that's not the kata, because that's not. But if it is, I'll give you something on that. But what I want to say is that once you graduate the kata, you're going to end up learning to take a sniper exit like right in here. You're not going to let a full execution risk go against you. It will have gotten this far and then starts to reverse, and then to turn that into a loss, you're just not going to do that. Now this getting short right here in the pocket, and that's the PSAR flip. That's, again, this is a sideways. What I want you to notice when it comes to crafting your rules, you have a low, a higher low, you have a high. Whoops, that should be green, sorry. The hump of the dragon makes a high, and it makes another high. So this is actually an upward trend. That's favorable. And this going from a low to a higher low is actually favorable. So you want to be thinking about this exit that you took here should really be the long on this trade, which you didn't take. And this crossover here on a day when the market had a huge gap up and everything is going well. we should be taking this trade. And now if you use the Wu Wei management, with your entry here is fine. This stays in place until the PSAR dots get above your entry, which doesn't happen till up about here. At that point is when you then move this stop. Oops. You move that stop up to the Bollinger Band mean, and then you're going to get a nice exit here. You'll get that exit. Okay. So that's going to help you. And trade 6 looks fine. Here's some SPY kata. It seems to me shut up. Why is that not going to work for me? Even the ink won't work for me now. God damn it. All right, it seems like what can I do with this pen? This exit here should be a stop and reverse, and you should be getting this trade. You should be getting that trade. And this one is nicely done. I think with such an extreme breakdown here that you're getting a 1, 2, 3 right here, and this is my idea before about when you have these nice long moves, that if you're starting to trail these, you might end up getting this entry here. Instead of taking the exit right there, you could actually be stopping, reversing here, and then you're going to get that move, and it front runs that. So I've been playing around with that, and I really, really like it. Especially when you have that move up is so big, it gives you a really wide risk box for management anyway. I think you guys are going to end up liking that idea a lot. I think we've already seen those. Let's see. I'm not sure whose this one is. I think this is Scott. Got a good start in Brazil, and this was perfectly played. I remember calling that one out in the chat room. I didn't have time to trade it, but beautiful breakdown from the OR5, gets through the dragon, perfect short, and then a very nice sniper exit, and then you get a low and a higher low, and then it crosses, and then off he goes, cash, stop and reverse. So this is one of those where the up, flat up becomes an automatic re-entry because it failed to fail. So that was really nicely played right there. And this is the last series. I think this is from Stephen. Yeah. And brings in about 3.25 execution R today. Really good stop and reverse here on trade 17 to 18. That's nicely done. And I think I've already commented on that as far as getting the stop here at the trailing that PSAR -1, that second dot. All right, guys, that's everything I got. Let's keep fiddling around with this. My new laptop came in today. I'm hoping that I don't have these pen problems with it. It just, for some reason, just froze on me right in the middle of this. Oh, I know what I wanted to do. I'm sorry. I do have some more for you. Hang on. Okay, so this was one that I did last night after the workshop was over, or the nightly session was over, and there were some more email exchanges among the traders. So this continues the discussion on, hey Ken, how do you pick your symbols for day trading? Which is really, how do you narrow the focus? Which indicator do you love? And the point that I'm trying to reinforce here is that, let's see if this thing's going to cooperate. Yay. The time for indicators is when you're planning. That's the only time that I'm really caring about the indicators, because I'm using those to take measurements. And that's allowing me to develop my target list and then find the themes. Where are the anomalies? What are the extreme readings on all these different indicators? And then when the planning is done, I have a list of symbols that I can prepare. So the time for indicators is over. Now it's time for trade framing. The time for trade framing is when we're in preparation. And then what we're doing is that we are preparing for each symbol a robust scaffolding of price levels that seem to be significant. Once we've created that scaffolding, it's now the time for price. When price matters, the time for price is execution. So I'm not looking at those other indicators and seeing it. No, what I'm doing is I'm looking at those price lines and levels. And what I'm trying to do in execution is ruthlessly following price and following those moving targets. Find the mover and attack it. I've already laid out the price levels where activity should occur. Then the time for adapting is during assessment. So here's our plan, prepare, execute, and assess phases. And we're doing different things in each one. There's a different purpose. So if something has gotten out of planning, it's good enough to trade. And then that means I'm going to take the first one off that list. Once I've prepared them, the first one that crosses the red line and triggers the alert is the one that gets it. So I'm not going to prefer if there's something moving right now and it hit the trigger, it stepped in the trap. I'm not going to not trade that because I'm waiting for some other one that hasn't moved to start moving. I have 10 things that might move, and if they move, it could be big. And here's the first one, and it's starting to move, so I take it. So I'm not preferring anything. Anything on that list is good enough to trade if it hits its trigger. Then I can go back later and make an assessment and a judgment about how good my framing was and patterns and all that stuff. And I'm going to use the law of large numbers to do evidence-based management. So just remember, the only thing the plan has to do, it just has to find targets. That's all. And preparation, it just has to prepare trade frames by working it in both directions. So there's no directional bias. And then execution, all I have to do is just follow price. I don't have to do any thinking. I just have to follow price. And then the assessment, all I have to do is I just have to learn lessons. So if I was going to verb those things, I would say, look, here's your mantra. Find targets, prepare frames, follow price, learn lessons. And that is how I'm managing risk. And who's managing my risk? Well, once I get into the trade, my little fireman is going to get me to no lose plus dinner for two, and then take that chimp with him. That's that strong chemical bond. So that the chimp is not interfering with the basic rules for managing and sniping. And then when I've exited the trade, my caretaker is going to take care of all these guys that are just suffering. And he's going to take care of all those guys, right? So find targets, prepare frames, follow the price, learn lessons, and that's how you manage risk with those people on your team. Now, here's some more words on focus, just for scale. So out of a universe of maybe 6,000 trading symbols, so that's the Wilshire 5,000 and all the commodities and currencies and ETFs and whatever, 6,000 things to choose from. All I do is I render that down, I simplify it into the herd. That's about the ETF 30 and the Dow 30 and probably 10 other symbols. Hey, Ken, that's 70. Yeah, well, I don't trade all of the ones in the Dow 30 and the ETF 30. So I don't have more than 50 on that step. Now, where are those 50? If you look on those charts where I show you the daily stack, from best to worst, those are the ones that are in my herd. Those are the only ones I'm even looking at. Now, out of those 50, when I've gone through the planning, there's probably 10 of them that are any good. And there's 3 sources of those, if you remember from yesterday's chart. Continuation patterns, frog champions, the usual suspects, and then new signals. So those are the 3 sources from the plan of things that I'm going to prepare. So when I'm using my goggles and my indicators here to study the herd in order to generate the 10 that I'm going to prepare, then those in preparation become these planning frames. Anything that got that far is worth trading as soon as it moves, and it's first come, first serve. So once I've got those individual frames, I'm then going to turn that into a logic chain with scenarios and rehearsals, so I can visualize those different combinations and possibilities tomorrow so that I'm not surprised. Yeah, I know, and I'm going to consider market, sectors, and then targets within the sector. And we saw why yesterday, because there was a moment when the S&P was up 1% and energy was up 3%, and Devon or no, XLB was up 3%, and Alcoa was up 10%. So the market was up, XLB was better, and Alcoa was best. So I found the mover. And all I'm doing there in execution, after I've done my little trading preparation and created my scenarios and contingency plans and rehearsals, all I'm doing is following price. I'm going to detect which ones are hitting their triggers, decide to trade it or not, deliver the entry, and then assess it continuously until I exit. So I'm using alerts to help me know when price crosses a line. I'm using the management techniques of Wu Wei with the fireman and the manager doing the business until the sniper gets activated when I get a couple execution R in hand. And I'm just focusing on relentless execution and zero state management. So that detect, decide, deliver, assess is our D3A process. Detect the signal, decide to trade it or not, deliver the entry, and make the decisions, and then continually assess it so I can manage it. And then when everything is said and done, assess the overall trade. Plan, prepare, execute, and assess. Find targets, prepare frames, follow price, learn lessons, manage risk. This was just this is the way I described it yesterday. The initial question was, come on, pen. Here we go. The question was, how do I find the targets? That really was a question of, how do I narrow the list, which becomes a question of, how should I prioritize and how could I prioritize? And what I wanted to say was that if system, self, and market, these components of the overall trading process, these shoulds and coulds, this is where all the variables are. You're not trying to trade just like me, you're trying to trade like you. So the narrowing of focus is a simplification. That simplification, you got to remember, you got a lot of choices in how to simplify, and every simplification comes at a certain cost. Sometimes it's opportunity cost. Like if you simplified and didn't have that thing on your list and you didn't see it and didn't get it, there's a cost of simplifying, but there's also a benefit of simplifying. So when you're doing your assessment, cost versus benefits, what you're trying to do is create value from the way that you are narrowing your focus. So this is just another way of saying, where do those 6,000 symbols come from? The Wilshire, commodities, currencies, different kinds of instruments, and all the different time frames, and all the choices you have about how to simplify your life. And there are many. The ones I use are, first of all, I kind of break it down by time and style. And I try to do certain things just at the strategic level with the core system. And then I have simplified my life on how I do operational swing trading. And then tactical day trading. Each of those has its own processes and specialties for core that equates to core, swing, and day. And then, as you've seen me over the last 4 months, the way I blend those together is what I'm calling hybrid trading. That's where the core and turbo comes from. Now, you could do any one of those or combinations of those, and the more things you do, the more complexity you're adding. So you have choices on how to proceed with this narrowing of focus and the simplifying. Other ways that I simplify. You just saw me talk my way through instead of looking at 6,000 symbols with a dozen different systems, I just look at the elements of the herd, ETF 30, Dow 30, and some specials. I also simplify by the source of the signal or the style of trade, where I love continuations, and I'm going to prioritize those first because I already have skin in the game. And then I like frog champions because they're so simple and they move so reliably. And then I would prioritize new signals. But I'll tell you, if I had a busy trading day and I had 5 continuation patterns to carry forward and 5 frog champions were in the zone, I may not even look at the new signals. I mean, I might, but I might not even prepare them. Then when it comes to execution, you got to decide, do you want to go with just mechanical systems? And then you can just follow the rules with a certain allocation. And then you're not even prioritizing. Or you could just prioritize some mechanical signals. Where it adds some complexity is if you're using strategies where judgment is concerned, then you could legitimately say, well, which strategy do I want to try? And that's where kata comes in, because that's going to help you clarify these systems and strategies. And from that, you might pick 1 or 2 things that you just want to specialize in. You could pick 100 symbols and use 2 katas, or you could have 10 symbols with 10 strategies, or 1 symbol with 50 strategies. I probably fall more into this kind of a category where I have a handful of symbols and a handful of techniques. Now, when I am making those simplifications, in planning and preparation, then I'm also going to improve or lower the cognitive cost of things by creating these pieces of standard work, standard procedures for how I'm going to apply, standard way of how I find the targets. You see me doing the same thing every day in the same sequence to find targets. You see me framing all of them, regardless of the source, in the same way. You see me always integrating those and creating logic chains so that the frames are not separate and distinct, but they're part of a narrative for the day. And I conduct a standard rehearsal so I'm not surprised by contingencies. And I have standard kind of entries. That's the MMRB. MMRB. Once I can see that little thing and I'm in, I'm in. And then I have the standard, I'm not even thinking anymore. Like, you want me to prioritize which open trade I'm going to manage? If I had to stop and think about that, I'll just get out of all of them. But I don't have to, I can manage up to 4 at once without having to prioritize one or the other. So standard management techniques and standard exit techniques. So no matter how I got in or what the original source of the symbol or strategy is, it's a standard management and standard exit. And then standard units of risk so that I'm not losing my mind. And then standard ways of assessing, adjusting, and adapting. So I really want to reinforce that if you listen to that, now maybe this makes a little more sense. The previous one that I just said, hey, I'm not prioritizing. Well, which do I like better, the 5DD or the triple screen? I like them both equally because if they give me a target, it's in a critical state and I will frame the trade no matter where it came from. And that goes into the stack of the things that I'm going to trade or to be ready to trade. And then it's first comes, first serve. Find targets, prepare frames, follow price, learn lessons, manage risk. Simple. Simpler. To review, planning. It's just a list of potential movers, and they're all in a critical state regardless of the source. Preparation is the most important. I'm using principles of standard work, trade framing each target, developing logic chains, rehearsing the scenarios and decisions, and then preparing standard patterns, executing those standard patterns, standard management, standard zero state, and getting into and out of it, time, will, pattern, and money. Standard work for money management, risk control, and monitoring my span of control. And then on the assessment, I'm evaluating how well did I plan, prepare, execute, and assess. And that's sustains, improves, and action. So, Griff, that's what you're going to be doing, is you're going to take a look at your 5 days. You're going to do sustain, improve, and action for plan, prepare, execute, and assess. I'll give you a form for that. So after I've evaluated it, then I can refine my understanding of what's going on by using the sustains, improves, and actions. And then I'm going to pick a couple things and commit to action, which includes what's my accountability for following through on the things that I committed to. Who's my accountability partner? What's the forcing function? And then I'm going to be committed to continuous improvement. Well, that's where your learning journal is the most important book on trading that you can read, because it's the one you write. So here's your homework assignment, quiz. In this whole process of simplifying and focusing and prioritizing, how does kata help? And how can you use it to help you frame your hypothesis for research? So Griff, you're getting ready to analyze 5 days of kata. How does the kata help you establish a hypothesis for testing and researching for improvements to the kata rules based on your observations of what went well, what went poorly, what could be improved on, what's the evidence for it, what's your hypothesis? Now you have the basis for framing a hypothesis of how you propose to adjust the rules to fit your experience. Then you can conduct research with paper trading or forward trading with 2 shares, or whatever you decide to do for risk management, to follow through in that hypothesis to see if the thing you propose to do is actually a good thing. Because now you can write your adjustment to the kata as a rule set, and now you know that you can follow rules. So we're not going to accept any excuse of why you didn't follow your own rules. You proved you could follow my rules, so now just prove you can follow your rules. So by studying the results of the kata, you can now frame a hypothesis for how you propose to change. You could do something as simple as, I propose to use the Wu Wei exit to see if that's an improvement over the just use the PSAR. It is, I believe. I have evidence to believe in it. But you need to do your own research. And if you like what you find, then you might then adopt the Wu Wei exit management as part of your system. So kata plus Wu Wei might be the basis for your system, or a rule for how you're going to activate your sniper, because that's judgment call for you. So that's your quiz. How does kata help in this whole process of demystifying and taking ownership of your decisions? So this is here's a peek behind, that's everything I wanted to cover formally for today. Here's just one for you, a peek behind the curtain at Muppet Labs. This is Bob and I working together on something. So we're kicking around this idea about the difference between, but the relationship between temperature, weather, and climate. So if you think about day trading, tactical, swing trading, and then core, you might be concerned about the last 30 days to identify the current trend, maybe with the slope stat, and then the slope of that 30 period regression line compared to the baseline or the market or the zero line. That gives you a particular reading and value on an indicator. So it's 30 days might be that what's the temperature today? Well, you might want to know, well, I know what the temperature is. That's just a fact. So if I want to put that in context, I might say, well, let me look at the last 300 days and establish some kind of max and min and average, and then plus or minus 1 and 2 standard deviations of those 300. And now I can place this particular reading of that slope stat inside a z-score context. So if I'm using the slope stat over here, I might be just tracking the slope and then assigning a z-score value to it. Now you can see that I'm tracking how his slope has changed through time, and you know where the peaks and valleys are in the z-scores. I'm looking for major and minor turning points. And then I can see, well, today, what's the directionality? Oh, it's not only this particular slope stat, but now I can put it into context and make some meaningful statements about it. Well, if the day is temperature, the weather might be 300 days of context. If I looked out to 3,000 days, I might now be able to do some climate. Like I could judge, in the same way that I could judge temperature in terms of weather patterns, I can now judge the current weather patterns of the last 300 days inside the context of the last 3,000 days, where I'm now looking at how the weather patterns are shifting in long-term eras or ages or epochs. So this is like maybe looking at the effect of long-term secular moves. So if each one of these was a 300 block of days, and there's 10 of them, that would give me 3,000 days of look back. And so I could now look at the current set of 300, that's this block, and I can see, yeah, that's the max and that's the min, but you know, in terms of historical spreads, that was nothing. Like, hey, just 1,500 days ago, the spread between max and min was that big. And there was at a peak of volatility, and then it came back down to, so now this particular set of context is historically compressed. So now I can check how the context of normal and abnormal ebbs and flows and rising and falling. So that's the same way that we look at for the advanced frog traders. We can look at the short-term frog box, which is the standard deviation of the last 30 days of ranges. That tends to vary based on short-term volatility changes. But if I want to know what the long-term stable normal is, instead of going back 30 days, I might go back 300 days. And then I might take the short-term frog box, the current volatility, and divide it by the long-term frog box, and come up with what we might call a frog box index, the FBI. And there's three possibilities when I make that. You'll notice that's the same way that we do the, it's the 30 period divided by the 10 for the risk Z. And we're computing a Z-score here. We're looking at short-term volatility and longer-term volatility to come up with something like weather patterns or climate change. So if I do this short-term frog box divided by the long-term frog box, there's three possibilities. If those two were exactly the same, the short-term frog box is equal to the long-term, then we would say, we're aligned with long-term trends of volatility. So this is absolutely normal for the frog box to be that big inside that range. But if the short-term frog box was greater than the long-term frog box, then clearly this number is going to be bigger than 1. And now we can say, we are experiencing a period of abnormally large volatility. And we might use that to inform some judgments we make about risk management. But if the short-term frog box was less than the long-term frog box, we would say, that's very good. We are in a period of relative quietude, and that's probably something like leading to a Z3 pinch. And then when that volatility, which is abnormally quiet, that could be amazing. And I just answered my own quiz. Well, how could I use these ideas? Well, so we're just noodling around. This is the kind of stuff that we do in the research weekend. We're studying this kinds of stuff because there are some robust ideas that are just part of the business. Like we're concerned with how the current condition of normal versus abnormal compares to long-term historical norms. So whether we're talking the slope stat has a current reading and here's the max and here's the min, well, that spread between max and min historically, is that narrow or wide? Well, I have to look at the larger context and maybe these epochs to answer that question of how does it compare to longer term historical norms? Or I may be looking at volatility down here in terms of the frog box. So this comparison of temperature versus weather versus climate is a way that you don't get surprised by recency bias. And sometimes if you're a real short-term trader, recency bias is the last 5 minutes. And you think long-term is the last 300 days. But for long-term position holders, swing trading is fast for them. And their long-term horizon might be 3,000 days, which is 15 or maybe 15 years. So they get informed by different habits of mind. So in order not to be surprised by what's happening in the market, when the regime changes, when the epoch changes, you're going from the little ice age to a warming period. Well, okay. So there's some applications now for indicators. For measures, the things that we like to measure, we're looking for extreme moves, for measures of extreme moves, and that could be in the range of volatility or the degree of trendiness or how widely dispersed the correlation coefficients are between major indices. Did you know that for a long time gold and the S&P were inversely correlated? Yeah, they were. Did you know that right now they are not correlated at all? Yeah, that's true. And that degree of correlation goes from not correlated at all to highly correlated in a long-term secular cycle. You might want to know that if you were thinking about using gold as a hedge to the S&P or as a way to reinforce the S&P. But if it's not correlated, it's not a hedge at all. And then you might want to know something about the logic change, these logical relationships between two or more instruments. How much do their correlations of multiple asset classes change over time? And where is that correlation today? And then how fast does the change in correlations go? So if you see this long, smooth curve, is that normal or does it go like this with rapid fluctuations? How fast is the change? How stable and orderly is it? So if you want to do more research on that, the concept that we're talking about there is the idea of stationarity, and that is how long-term stable are these different models and assumptions and the data that they are based on. So when you're trying to learn how to sit on your hands and not chase every other idea, and you're going to wait 15 or 30 minutes or 2 days or 3 hours or whatever between decisions, you got to work on something. So this is where some long-term ideas come from, and we're working on these. I really like this idea of the slope statistic, and also on this long-term and short-term frog box, because what this thing does, you could imagine that if the long-term frog box was always was that number, but today the frog box had compressed down into here, hey, that's abnormally small. That would give you an index of about 0.4. So you might want to know what that number is to determine is this something that is really well postured for like a Z3 pinch breakout. And I guarantee you, there's not too many people in the world who are looking at the market through that lens. That's a really interesting way to find things that haven't yet moved. That's like popcorn, right? So here's my popcorn analogy. I hope you like it. Here's another idea for it. I'm gonna talk about popcorn right here. So let's suppose that popcorn in my microwave takes 90 seconds to complete. And when the last 10 bags of popcorn that I put in there, the first kernel didn't start popping till the earliest was about 1 second before, but almost all the time it starts popping right about the 45 second. So you get this kind of curve. And then at 90 seconds, 98% of the kernels have popped. And so if I go beyond 90, they all start burning, and then the quality just drops way off. So 90 seconds is what you set on there, and you've got only a 2% error rate. Well, if you had some kind of reliable system process that looked like that, like some kind of secular model, you might actually find that the curve looks something like this. That most of them occur in that little window, and that after this, there's a point of diminishing returns. So the sweet spot might be between 45 and 75 seconds. Actually, it's probably more like here, probably about 75 to 85 seconds. So you get some kind of curve that looks like this. Well, while you're waiting, you're not getting any popcorn. All of your popcorn action is happening here. So what happens on a system that the guy doesn't know that he's just buying popcorn, and the volatility, he says, man, there's nothing happening here. Those Z3 lines have pinched, this thing is sideways quiet channel. The heck with it, I'm just going to leave. He doesn't. So what I want to do is I want to buy bags of popcorn that have been in the microwave for about 40 seconds, knowing that in about 5 seconds that thing's going to start taking off, and I'm going to get some kind of measured response, and I have enough predictability on it. I know what the reasonable moves are. So maybe that's our 2R battle drill. And once I got my 2R, I'm ready to cycle this, and now I can do one bag, one bag, one bag, and now I'm doing cycling, and I'm not sticking around forever. No, it's going to pop. It's going to no. I can just study the historical trends. When it goes through a period of quietude, and then it expands, and then it comes back into quietude. How long does it take? How long does it spend in terms of time in these big directional moves? And how far do they move? And then I can now start looking for things that are sideways quiet channel or super pinched, knowing that when the longer it stays in that sideways quiet channel, the greater the probability of these large directional moves in either direction, which catches people by surprise. And then when that thing starts breaking down, it attracts momentum players, and that's where that extra money is coming in. So if I can find those sideways quiet channels that are becoming super pinches, that's really what I want to do. So now this idea of the long-term frog box versus the short-term frog box is an amazing idea. Now, you've seen me do the NDX table where I have, the 270, the 90, the 30, the 10, and the 3, and I sort it by the 10 into, into red, the red, the yellow, the white, and then the green. And the reason is because I always like these things that are oversold on a 10-day basis, because I think that's sort of like it was up, sold off sharply, and it's just getting ready to turn. And what's that look like? Well, that's how I find SSCs, by looking at those things. But I know other things being equal, that these things that are excellent, these are ones that have maybe done this and are ready to keep going, maybe. So I like to look at the extremes. So that table is a way, and very efficiently, you get 30 symbols from the Dow and 30 symbols from the ETF. So you got 60 symbols looking at 5 different integrated time periods of look back. Now, I can see those patterns easily, but I was just thinking of another way to visualize that. Was supposing I was just a swing trader or a core trader or a position trader, I might do some kind of dashboard. I could do it maybe this way. And now I get this sense of things that are just made new breakdowns or new breakouts. And now here's my my oversold, and here's my overbought, and here's that plus. Here's my average line at 50. So here's things that are in the plus, and here's the things that are in the minus. And now what I've done is I've arrayed market, sectors, and targets. So what I've done is put a little relative logic chain together here, and it turns. I said our NDX 270, but I was using the NDX 10 actually to come up with the numbers. I was just fiddling around with this. So right now, today, the S&P is in this overbought at about 94. But DIA and IWM both broke out higher than 100 on their 10-day. So they're actually in better shape than the S&P. Then these were the 3 strongest sectors, all above 100. Metals and mining, materials, and finance. And U.S. steel was also above 100. So here's a logic chain of XME to U.S. steel. Now, in other sectors or countries, Brazil is slightly lagging. Mexico is really lagging. In fact, it was as bad as anything on that stack. And now you can see just how visually Microsoft is bad compared to Apple and Walmart and U.S. Steel. So all other things being equal, Microsoft, if you love them, they're more on sale than Apple. And if you say there's some natural upper limit where all the discretionary guys are in here, there's just more room to run in Microsoft. So in terms of dashboarding, a spreadsheet that I have in my daily report that's very complex, carries a lot of information, but it may be hard to visualize. But what I'm actually doing in my head, in the little movie theater in my head, is I'm doing this thing where I'm looking for the extremes and looking for trends. I'm kind of ignoring all this crap in the middle. And I'm looking for anomalies. I'm looking for a guy who had a great 10-day, but whose 30, 90, and 270 were weak. So a sudden appearance of him says, oh, maybe this thing was horrible and now just started a short-term move. So that's how I'm using that chart to try to find potential movers before they move. So I just wanted to share that idea with you about some of the concepts behind dashboarding and the difference between normal and abnormal and why that is a long-term, robust strategy for success. So that's everything I wanted to cover. So take good care, and we will see you tomorrow.